Thank you, Tina, for that great introduction, and thank you, everybody, for that virtual applause. Um, it's good to be back here at the IAA Los Angeles chapter, and appreciate the opportunity to share a lot about this rule with folks. There's been a lot published on this rule, and you're going to hear some more about it. Are you ready for this, Alex?
I'm ready. Yeah, and a pleasure to be here.
So there's been a lot published about this rule, a lot of questions, and much of what I've seen come across the wire has been a dutiful summary of some of the highlights. But the more people learn about it, the more questions they have. So our objective here today is to provide some really thoughtful content and analysis about the rule itself and some context around the rule, and to ultimately empower the folks on this call to be conversant about the rule and about the underlying risks and issues in your organizations and within the community, and even to step up and make comments to the rule because the SEC is inviting them. The more we read, the more we think, how come people don't know this? Well, one of the ways we can fix that is just get out there and share what's in there with folks. So appreciate everybody tuning in. The agenda is there. We'll just go through that. No good presentation would be complete without a disclaimer that really there's no warranty express or implied. This does not constitute a consulting relationship, but even if you might decide you need one from somebody by the end of it. And just as another point, Alex and I are both chemical engineers. So we are not CPAs. We're in a room full of CPAs. We're accustomed to working with CPAs. We love CPAs. But when it comes to the real accounting nitty gritty, we are not CPAs. I think it's important to understand a little bit of context and background. One thing I've heard from a lot of folks is, where did this come from and how come this came about all of a sudden? Well, it really didn't. So we want to provide some context on how climate change affects companies and why SEC is involved and what's going on in the world stage, because this is not occurring in isolation. There's the timeline goes back here, I would say, at least 30 years. In 2000, the Carbon Disclosure Project, now rebranded to CDP, began because stakeholders wanted companies to disclose what their greenhouse gas emissions were, and they just weren't doing it. So they started this organization to voluntarily request companies to disclose their emissions. And sure enough, a lot of them did. The last two bullets there highlight the fact that there were even some standards to evaluate and validate the emissions disclosures, whether it went through CDP and elsewhere. Alex, you had some involvement in about this time frame with greenhouse gas protocol too, is that right?
That's correct, yeah. So WRI at that point, in between 1999 and 2000, were generating the corporate standard. Now, just like to reinforce that, like all these this validation, verification exercise were already happening circa 2000. So this is, it's new, but it's not that new.
WRI being the World Resources Institute, yeah. A global group using a transparent process to develop a protocol for calculating greenhouse gas emissions. SEC has been on board with this for over a decade. In 2010, they issued guidance about climate risk in 10K, saying, well, if climate change poses a material risk, and that's what Form 10K is about, then you should be disclosing factors about that risk in your 10K. If it's a material risk, it belongs there. Companies still weren't really doing it, and many organizations complain, well, so complex, we can't really figure it out. We don't know how it applies to us. And in 2011, a group called the Sustainability Accounting Standards Board just set itself up, and essentially, in my words, they said, fine, then we'll do that for you. They went through an open, very public process. They applied existing law. They applied the Supreme Court's definition of materiality. And for all things ESG, not just climate change, They took several years and developed SASB accounting and reporting standards for 77 industries and released them publicly. The EU in 2014 took a major step and released a non-financial reporting directive, again, for all things ESG, environmental, social governance, climate change being a big part of that, requiring companies to do public reports on their non-financial reporting. Michael Bloomberg and several former SEC commissioners were on the board of SASB from the outset. And with climate change emerging as the issue of our time, they felt it was time to create a separate body just around climate change. And the Financial Standards Board recognized that climate change did pose a threat to the stability of the financial system worldwide. So they launched the Task Force on Climate-Related Disclosures, Financial Disclosures, TCFD. And a couple of years later, the framework was released. So this has been on the move for a while, and there were a couple developments here late last year, a couple of years ago. Alex, you want to talk to the taxonomy?
Sure. The taxonomy, this is mostly applicable to the financial sector, but the taxonomy is the UN EU version of what we're seeing here. So it's a push to basically standardize disclosures, and it establishes what qualifies as green investment. And particularly this year, beginning of this year, January, some of the mandates kicked in. So you'll see that it could be that you're already involved, or some of the folks that you work with might have already gotten some kind of, questions around it.
So if you're going for a green investment, or if you want to say you have a green investment, there are some provisions around what does that mean. And that is something that I think we will see more worldwide. In the last year, things really picked up the pace. That in March of last year, SEC invited public comment. Commissioner Allison Heron-Lee went public, and there were several hundred comments received. And just to show the extent of uptake to the CDP, over 3,000 emissions inventories were submitted in 2021. We saw a COP26 in Glasgow with a lot of pronouncements around commitments to climate change. COP is the Conference of the Parties, and those are the signatories all the way back to the Rio Declaration in, I think, 1992. And there's been a COP every year. Next year, there will be a COP27. In November, one of the companies and organizations were kind of overwhelmed by all the groups clamoring for all the disclosure about all the different topics. And it was getting a little crazy. And there was some pull, especially from the preparers, to consolidate some of these, or to at least converge what's being asked for. There was a bunch of activity in the fourth quarter last year with some of these organizations merging. And one of the more recent ones and significant ones was the IFRS, International Financial Reporting Standards Foundation, created the International Sustainability Standards Board, which was the product of a couple mergers, and SASB, which in my view did a lot of the important groundwork, industry specific and based on existing law, is one of the organizations that has merged into ISSB. So here we are. What sparked this particular webinar was the 21st of March announcement of the proposed rule on climate-related disclosures. And if you think there's a lot to keep up with, you're right, because just 10 days later, the ISSB released their proposed standards, and a lot of folks are trying to compare the two and make sense of them. And the SEC comment period is now open, and you've got several more weeks to comment on that. And I hope maybe by the end of this, you will feel compelled to do so, or influence your organization the same. So that's some of the context. Why don't we open a polling question, Tina? So the first polling question would be, what should investors be entitled to know about an organization's climate-related risks. So look forward to seeing how people respond. Well, the responses are here. We go.
There we go. Good.
Yeah. Okay, so we have 18. Let's give it about another, what, 10, 15, 20 seconds?
Yes.
You know,
that sounds good.
There's no runaway winner. And I think that's about what I would expect. And if everyone answering a question is an investor with a strong interest in this particular topic, she or he will not rest until they get answers to those topics. And I think when we go through the proposed rule, you'll see that the SEC has gone out of their way to make everybody happy. So it's interesting to know that we're going to stop the poll. Let's see. Let's share the results. Oh, I guess maybe. Are the results visible here on the screen?
They should be, but if not, I can read them off to you if you're not able to see them.
I can see them.
We can see them.
Okay, good. Thank you. So it's a pretty even distribution. There's no runaway winner, and I think that's really the takeaway here. So we'll just stop sharing that for the moment. Let's do that. Show the results. So I get to show the results. Stop sharing. Just going to close the poll and move on here. Get back to the slideshow. So before we get into it, I wrote my first sustainability report. I think it's 20 years ago now, and have been involved in that arena ever since, to write, evaluate, audit, and the like ESG reports, I think we call them now mostly. There are three attributes that strike me as being very different from financial reporting. Alex and I both worked for a Big Four firm. I started there 20 years ago this month, supporting financial audits and disclosures and the like. But the ESG or sustainability reporting is different, I think, in three key ways. One is that it's about control and influence. Much of the sustainability risk and requirements extend beyond the four corners of what an organization controls and into the supply chain, into the value chain, into the community, and into parties that the organization does not control. But the organization is expected to have controls and policies, procedures, and report on that. So I think the extent of influence is very different. The sustainability reporting includes a lot more narrative, a lot more qualitative disclosures and reporting about processes and policies and commitments and programs, and not just stories that make the marketing people happen, but qualitative information about ESG programs and commitments. And the third attribute is the extent to which ESG disclosures are prospective. They're not just a snapshot of a prior reporting period, the prior 12 months. They disclose what the company is intending to do and how it's charting its course for the future. And this is something investors are really interested in because they want to know the resilience and how the companies are positioning themselves to achieve financial value and performance in the years ahead. So we'll just dive right into the proposed rule and cover a lot of options of them. It was announced, there's the cover page of 510, if you care to read them all. We'll go over some stats here on it. There are 1,068 footnotes. Many of them go to other reports. Some of them go to comments that were submitted last year. There are 13 major topics in the discussion section. I did a page count on the different, or a word count on the number of times these terms appear. TCFD is referenced a lot. Greenhouse gas protocol is referenced a lot. Greenwash and fraud make an appearance. Could and might appear throughout the document on what could happen or what investor might want to know. The term assurance is the runaway winner on this screen, that the investors are clamoring to know if what they're seeing can be relied upon. And internal audit clocked in with exactly one mention in 510 pages. And I, for one, find that kind of disheartening. And with my comments, and I think with some others, we're going to try to muscle in and show how internal audit can add value to this whole process. I submitted comments last year, and my gosh, they were referenced 4 times in the footnotes. And I think that shows that if you have an opinion or a thought, write it down and send it in, because SEC does read these, they do consider them, and they can have an influence on what comes out in a final rule. And some of the folks on this call were probably in the room when I did my first presentation to this group 10.5 years ago on climate change risk and internal audit. Maybe that was a little early, but it's caught up. In the proposed rule, there are 202 specific questions where the SEC is asking comment. In hour 2, we'll go through a few of those questions and share some perspectives on what those questions mean and how they may influence organizations and where internal audit may have a role. And you've still got some time to comment on the rule. I also did a page count of how many pages are to these particular topics. These are, I would say, the most important sections of the discussion, and more pages than anything were about the greenhouse gas emissions metrics, the financial statement metrics, and the attestation of the scope 1 and scope 2 metrics. That's part of the greenhouse gas metrics. We'll see more about that here in a minute. And those bottom 2 in yellow were the winner. The number of pages that are devoted to backwards looking numerical information was in the majority, and the number of pages devoted to things that are forward looking and qualitative, not so many pages. But one of the things in reading the rule, I would maintain that getting the narrative and getting the forward-looking information right will be more of a challenge. So I'd encourage you to pay attention to those topics themselves. So on the historical periods, the proposed rule, the reporting periods match the fiscal year. The proposed rule would require disclosures for the current fiscal year and 2 prior years, and will relate to balance sheet and income statement items. One of the things I see as a potential problem for disclosures, if this went through as proposed, is that much of the information in the rule is really not available for the 2 prior fiscal years. That companies do not have the systems or internal controls to gather data retroactively, or if they do, there could be some significant gaps that the information and data might not be up to the par that companies like to have when they're making a disclosure to the SEC.
Now to say, Doug, the prior year, we have to remember it was a COVID year. So the data might, even if you have it, it would be atypical. It's going to be an outlier. So
that's right.
To think about.
Very good point. The last 2 years have been anything but normal, right? Alex and I both worked on financial audit teams looking at contingent environmental liabilities, the reserves for those, the set-asides for asset retirement obligations. Those are on balance sheet, and the expenditures for those go to the income statement. The proposed rule would require would have disclosure thresholds for any of those line items on the balance sheet or income statement. If the effect of climate change exceeds more than 1% of that line item, then that financial impact must be disclosed. If it originates from anywhere in the consolidated financial statements. This applies to expenses to address and mitigate weather events and transition activities. You'll see these 2 buckets throughout discussions of climate change. things that affect your operations or on activities on an ongoing basis. Transition risk is the kind of risks that could be incurred as the world transitions to a lower carbon economy. Fines, or whether that's compliance requirements or costs of fuel, carbon taxes, and anything else. One of the pillars that we see in the global standards, including TCFD, is governance is the first of 4 pillars that's always discussed. There are some provisions here from the proposed rule, and I've highlighted in that dark red or kind of brown text there things that have at least one of the attributes that I think are distinctive to ESG disclosures, either forward-looking, qualitative, or influence. So the disclosure would require, how does the board oversee climate-related risks? Who is the member? What is the committee? What is their expertise on it? How are they informed about climate-related risk? How do they incorporate that as part of business strategy? Whether or how the board sets climate-related targets or goals, and all the same questions for management. A lot of this is process. And as I look at this, who's having the discussions and informing the board about climate-related risk? Internal audit, I would say, is in a good position to put that on the table to make sure it's discussed, because we have those conversations with the board already about risks. And there's also the option to disclose this for opportunities. That's a consistent thread throughout the proposed rule, that the disclosures as they relate to risks or potential adverse effects are mandatory. All the same topics apply to opportunities. If you are in a business launching a product or service that will make money from the climate-related risk because you have a smarter, better way of doing something, you can disclose those opportunities, but that is not mandatory. That's consistent throughout the rule. The second pillar that you often see is in strategy, business model, and outlook. So how is the company, the registrant, incorporating climate-related risks on everything they will do? So is it reasonably likely to have a material impact on any of the things you see there? The financial statements, will it be over a short, medium, or long term? Reasonably likely, I predict we'll have some spirited discussions on what that means. You may disclose the risks of opportunities. What are the risks, and are they physical or transitional? For physical risks, the proposed rule would have registrants disclose the location and of the properties and the nature of the risk. They defined location as zip code. So that would be the if you have facilities in your portfolio, or let's say in your supply chain, that could be subject to risk from flooding, sea level rise. The proposed rule would require disclosure of that location and its zip code, and the kind of climate-related risk the location is subject to. For the transitional risks, it would be to disclose the nature of transitional risks. Do you think in the future, a narrative, if that comes from regulatory, if it comes from the increased cost of energy, the increased cost for carbon emissions, and there's no specific way to define short, medium, and long term. And I was on a call within the last couple of days where, this could become difficult, because short, medium, and long term for whom? For the registrant, for the investor. One of the comments I've heard is that the different index funds and strategy funds, they're looking for things in short and medium, long term as they see it. The climate scientists are looking at things in short, medium, and long term through a different perspective. So it's not defined in the rule. And the point of the rule is to provide information that is comparable and decision useful. So I think that could be a bit of a gap.
Yeah, Doug, and even in like mature, accounting rules like asset retirement obligation, that there's still, no relative consensus on what those terms mean.
That's
so
right.
Even in a
Mhm.
mature, setting, it's questionable. There, it could be 30 years for some type of operations, but it could be, a couple of quarters for others. So
That's right. And even within one portfolio, it could be different.
Yeah.
So that, and there mean multiple definitions for each of those, even in one company. So
Yeah.
that could pose a challenge. So, and even more on the business model, what are the potential impacts? So what is, where do you draw the line for a potential impact? And that's forward-looking. What are the activities? What is the time horizon? What are the activities to mitigate those things? This is a forward-looking commitment, and we'll see, I don't know if it's here or later, we'll see that there's also the requirement to disclose how you have done as compared to prior reporting periods. So these forward-looking disclosures are establishing a basis and an expectation that that's your own report card. So you'll have to do your own report card later for all the things that are in these disclosure that are forward-looking plans. Here again, the word terms reasonably likely. So what is that for everybody? Alex, do you want to talk about the carbon price for a minute?
Sure, I'll be brief. From my experience in the World Bank, for example, carbon price is considered at the outset of these investments. So it's something that is plugged in, and it's not to say that other financial institutions, from Main Street, might not be using it, but for multilaterals, it's a must. So it's calculated, it's put into their modeling for feasibility, and they do keep up with the carbon market. So whatever that price is at that point. So currently it's around 10, but they do project things in the future, especially with the Paris Agreement, that might increase. So that's all baked in.
Yeah,
so I think that
$10 per ton of carbon emissions. Yeah. And the last point is really what they're interested in. If the risks change, can your company continue to create financial value? So it all really comes back to how it will affect you. Risk management, what is your process for identifying and assessing and managing the risk? Is it incorporated, or how is it considered relative to other risks? We see that word materiality there. Alex, this is really one of your key areas of expertise, risk management. Take it away.
Yeah, risk in this scenario is not as straightforward, as what would be the enterprise risk management model that we have. In particular, these cycles of risk have different, for example, transition risks are going to be quantified very different than your climate risks. But now these two need to be considered in tandem. So, and in my experience, it's not often that you find in companies that they have a risk register. So it's something that might be new to the operation. They might have, what the internal audit might see as the financial risk, but when you go into operations and things that these assets might be touching and activities, then it's a different story. So it's something that I see internal audit could help the company kind of build up to that as well.
And well, there are many discussions to be had about the concept of materiality. If we think back on that first polling question, all of those topics were material to the person who made that choice. Materiality has a certain definition from the U.S. Supreme Court for financial reporting in 10K. I predict we'll see a lot of spirited discussions about what is materiality. The proposed rule would have you discuss how those discussions happen and how you determine materiality. So again, picking up the pace maybe a little bit, if the registration has a transition plan, registrant then describe it, update the disclosures, so report on your own report card. I think the presumption is, the expectation is that you'd better have a transition plan. One way to get out of describing one is not to have one. I think the market would not look kindly to that. This sort of implies that every registrant should have a transition plan. And I think many organizations will be developing that from whole cloth. Okay, and here again, there is no mention of internal audit in anything in the risk management bucket of the proposed rule. And I think this is a core strength of the professions. And I'd like to see that mentioned explicitly in the final rule, whatever comes out. So now, Tina, let's open up for the second polling question. Thinking about some of the content we've just seen and the colored content on some of the slides, which of the attributes of ESG reporting do you think presents the greatest challenge? So we'll look for some of the results to come in, and we see those on the screen. Looks like a two-way duel here. Oh, influence is picking up a few votes. We have 25 of 28 people were quick to answer this one. So I think, what do you think about this, Alex?
I see. It's almost an even spread. Not to dismerit any one of these. I think they're all challenges. But I see that influence is a concept that might be new. And because of its many layers, it might be the one that I would pick as something that might take a little more of an exercise and deeper understanding. And in particular, if you move into, different scopes that we'll talk later, supply chain and value chain, that it changes a lot too. So that's
I would also notice that we were deliberate in not giving people the option of all of the above. So I think really that would have been the runaway winner if we had offered that as an option, because that really is the winner. Okay, so moving on, greenhouse gas emissions metrics, there's a lot of page count in this, and we're just going to zip through this pretty quickly to disclose the disaggregated by each constituent greenhouse gas. If you've sat and got into a car on a hot day, you know how that heats up the air. Well, carbon dioxide does that in the atmosphere, as do many other gases, some with multiples of the effect that carbon dioxide does. The proposed rule would require disaggregated reporting of each gas. It's pretty common for companies to report their emissions in carbon dioxide equivalents. And companies can purchase offsets to net out or to reduce the overall impact. That's a separate line item in this balance sheet, if you will, that your gross emissions and anything purchased have to be reported separately. Scope 1, 2, and 3, you should be familiar with this by now. We've summarized the key concepts there at the bottom for you. They're all to be disclosed separately. Alex has the distinction of helping to write the Scope 3 guidelines for reporting a while at a Big Four firm, close to 20 years ago. Alex, you want to share a comment here on Scope 3?
Sure. Scope, yeah, and I'm drinking my own poison here because like you said, I helped develop this. But there's many challenges to the Scope 3 part, because it's the indirect and it's in your value and supply chain. I would just we can talk on the second half of the presentation more deeply, but working with companies to look at supply chain and value chain and understanding the influence here is very complicated, and having determined accuracy and even completeness of that data is yet another problem. So
right.
Yeah.
So that's going to be a big challenge. That's really kind of the wild west when it comes to emissions reporting. And comparable data is going to be tough. But for many companies, Scope 3 is where all the emissions are. So I don't see any way out of having some component of Scope 3 in here, but managing the expectations and getting the numbers right, I think, is going to be a challenge. And for all of these, to describe the data sources, where it comes from, how you calculated it. And it's pretty common for greenhouse gas emissions to be disclosed in aggregate, the total, and also normalized. The intensity will be per unit of total revenue and per unit of production. So if you're a company, if you're a Home Depot and you have stores that look pretty much the same, that might be one way to do it. If you're an entertainment company with a movie studio and an amusement park and a research center, that could look very different. Or even look at a grocery store that looks pretty much the same, unless maybe they have a dairy that makes ice cream. So I think that's going to be a challenge for folks to do that per unit of production, because for many companies, even within the same sector, that looks different. So how did you come up with these? What's the approach? What are the tools you use? What are the organizational boundaries? If you used estimates, disclose those estimates, disclose those uncertainties. Some of these look very similar to what we see in the greenhouse gas protocol, which has been widely adopted by companies for, close to 20 years. Some of these look a little different. So some of these things already exist and are fairly mature. Some of these are a little different. And I would suggest that the narrative requirement in these disclosures goes beyond many of the other reporting arrangements that exist today. More on the metrics calculations. You must disclose any material changes in the previous fiscal year. So I'll share one example. If a company provides fleet vehicles to their employees, let's say they're all gasoline-powered vehicles, that's a fleet emission. You're combusting the fuel, and you have to calculate what those emissions are. And how you get the data, do you track mileage every month? If employees are using a P card to charge their gasoline, their fuel, do you back out the gallons of gasoline and calculate emissions factors? And then some of the employees transition to electric vehicles, and they're plugging them in and charging them at home. So now all of a sudden that's different. So do you just change the emissions? Do you change calculations? Do you disclose all that? It poses some issues where we have to make a decision about how it's calculated and how it's disclosed. And that's one example of many, many that come up, and they all require some thought, some design, some controls, and then input it into how you calculate the emissions and disclose any changes from prior reporting periods. That's just an example of how this gets pretty detailed.
I would say, Doug, that's like your examples of highlight how this is a blend between, I would say, almost an art and a science. It's a blend. So there's not a wrong answer. There are many right answers.
Right. Mm-hmm. So comparing them gets difficult, but you have to put a stake in the sand somewhere. There is a provision in there about safe harbor and about fraudulent statements, and it's not fraudulent with this description, and I could go a whole nother hour on fraud or misleading statements. The safe harbor provision does not extend as far as I thought it might, especially for all the forward-looking statements that are in this particular this proposal. It may be covered elsewhere in securities law. I'm not an attorney either, but we are seeing a lot of folks making investment decisions based upon ESG disclosures. The market for green investments is just going crazy. There's been some allegations already from someone who left a major bank in the EU that the ESG funds are just greenwash, and they're no different from anything else. And the expectation of investors that ESG companies or these disclosures are accurate and they're making decisions on their investments based upon these decisions, it's important to get them right because we're a litigious society. And I do see in the future that there could be some activity around this. Attestation. There's a section in the rule about attestation of greenhouse gas scope 1 and scope 2 emissions, not scope 3. It begins with a grace period moves to limited assurance, goes to reasonable assurance, and even what the attestation provider should be. What is the expertise in greenhouse gas emissions? We had in an earlier slide when CDP got going north of 20 years ago, there is a fairly robust community already of firms, largely engineering firms, consulting firms, and many of the accounting firms who do external validation, verification of greenhouse gas emissions reports. This is in a financial filing, so I think the presumption is that it would be, if not the financial auditor, then another firm with similar credentials. But a lot of this is being done by parties in a fairly mature way already. Here's what's in the proposed rule. And the attestation report must be included in a separately captioned section of the financial filing. And here are all the things that must be in that report. And some of that looks pretty standard. Some of that looks a little different. And you can take a look at that when you get our slides here after this session. And not only that, the registrant has to weigh in on their view of the attestation provider. If you set targets and goals, what are the scope? How are you've already set up your report card, so you have to fill out the report card every year on your data and progress. And again, on looking backward and comparing, there's no mention of internal audit in this section either. So here are some examples of targets and goals. This is not from the proposed rule. These are things that I've found and collected from online. The companies have made these targets and goals in several venues, not in financial filings. So the expectation sort of looks like if a company makes a disclosure like this or a goal that would have to migrate its way into an SEC filing, every Apple device sold will have net zero climate impact. Doesn't say by when, but is that a target? Is that a goal? Not sure. Does involvement in Transform to Net Zero or the climate, the project that Amazon announced, if that is a commitment, does that have to be in an SEC filing? We'll have to make some decisions about that. I call your attention to the last two, that Walmart has an initiative to avoid a gigaton of greenhouse gas emissions from the value chain. Trane Technologies is a big company, of course, that makes heating and air conditioning solutions. And one of their goals is to help reduce customers' carbon emissions by 1 gigaton by 2030. So I think that's a very elegant example of how Walmart influenced the business strategy of Trane Technologies. You can see that Trane Technologies is sending a signal to Walmart, we want to do business with you. Based upon your publicly stated goal, we will help you meet it. So there's a situation of looking outside the four corners of what a company does up and down the value chain, a forward-looking statement. And now these theoretically should be in the disclosure if the proposed rule went final. I think this could have a chilling effect actually on companies. They might think twice about standing up at a conference and saying we have a net zero water, we have 100% water recycling goal in the year 2040. What's the risk that could find its way into an SEC requirement? But this is where we are on the proposed rule. Let's have another polling question so people can get our CPEs. If everything was finalized in the proposed rule, how much effort do you think would be required at your organization? And I'll just say right now, if anybody answers E, we want to meet you and you're on the next webinar. Okay, we have 23, looks pretty good. 90%, we'll close at 92. So this is about what I would expect, especially given the extent of information that is being requested in the proposed rule, and I think this answer is correct. I don't think anybody's down there in E, so That's good. So let's move on here. So here are some suggested roles for internal audit. Our audience, I think, is mostly internal auditors, and it's never too soon to sit down at the table and do a consulting or advisory engagement. There's, of course, a gap analysis, a readiness assessment, a risk assessment. Many of the categories that we just saw on the prior slides are places where internal audit already has expertise and is involved in many different areas. So just get familiar with this. So I think some technical support can help you be more effective and focus on the right issues and understand what is going on in the profession and kind of what some good practices are. There's several places in here where assurance is mentioned around both the greenhouse gas emissions, and there has to be some assurance on the on what's at least in the financial statements. For the line items on the financial statements, income statement, balance sheet, those are already subject to internal controls over financial reporting. Anybody with SOX experience might dig a little deeper in that and become specialists in that area to do well by your organizations. One of the things, Alex and I both worked on those liabilities and asset retirement obligations for dozens of clients. I think having the numbers called out specifically in the filings might change how companies look at the level of detail on the internal controls for those issues. Ordinarily, I don't see those numbers in the financial filings today because they get swallowed up in terms of materiality. And unless you're a very large company with very large expenditures, the dollar figure is not published in the financial filings. Well, now if the dollar figure is called out, some of the controls that were not key controls before might look like key controls. So that's an easy area for internal audit to go look and see what's the state of those controls and how can you provide some help on the assurance side. Risk management, internal audit knows that for how do you come up with your annual plan, what goes into a specific audit, how do you discuss this issue with the board and your stakeholders. And it's certainly not too late to do some comments to SEC on the proposed rule, both in terms of how it affects your organization, how it affects the profession, and your own opinions. They are looking for them. So to kind of close out with our last polling question, let's push this, Tina. What involvement has internal audit had in climate-related issues at your organization? While we're doing this, Alex, any thoughts as we sort of get in the home stretch so far? Any more thoughts?
I would highlight that internal audit has that handshake with the board, so it can go way up in the structure and the organization. So it's like some of these non-financial, I'm going to underscore the word reporting, might still exist in a communication function. So it would be a blend between a PR and a public relation and a government relationship. So those internal audit can help move that discussion outside of us, there to something more of a decision-making process. So.
And that's a good point, that internal audit is really good about understanding criteria, right? And very early in governance, like the board members themselves, what are your credentials and qualifications? If internal audit is at the table discussing that with people on the board and they're hearing happy talk, it's kind of audit's role to say like, not quite sure that you get that. Here's what we see as better criteria for that, because you're really helping the board out. You have that's kind of a advocacy, a role playing. And if we want to be that trusted advisor, then let's go advise. So here we have, I think, a nice distribution that you have substantial and ongoing. Even with that, I think there's this proposed rule has a lot that nobody saw coming. This looks like a pretty good distribution. And some folks there now see that maybe here's a career opportunity for them to help your organization get started. So thank you for all of that. Okay. So we have contact information here, Tina. I think we're just about at time, right? Here's contact information for myself. Here's contact information for Alex.